Hello, thank you for joining me in this presentation. I hope you find it informative and enjoyable. My name is Nikolaj, and today's topic is choosing the best investment strategy for Lending Club. Throughout this presentation, I will aim to answer the question of how to allocate investment funds for minimum risk and maximum profit. To achieve this, I will take you through several steps so that you can gain a clear understanding of our proposed solution and its underlying reasons. We'll start with introduction. Lending Club is a peer-to-peer lending platform that connects borrowers with investors who provide funds for loans. Borrowers receive loans, and investors receive interest payments from borrowers. Lending Club generates revenue through fees charged to borrowers and investors. As investors on the platform, we are exposed to the risk that some borrowers default on their loans, and our job is to choose loans with low risk of default and aim to earn the best possible returns. We were provided with 3 years' worth of data, consisting of 7,000 records and 16 attributes. We cleaned the data and then conducted exploratory analysis to identify information that is unimportant or has no impact on our further analysis. Next, we moved on to predictive analysis, where we further cleaned the data by removing statistically insignificant features and retaining important ones. We used various techniques to classify loans as either bad or good, and for bad loans, we employed different models to predict the magnitude of potential loss. The next step is to separate borrowers into several groups where borrowers are similar within the group but different from other groups. To do this, we ran k-means clustering, and on the output we obtained 5 groups that represent all borrowers from the dataset. This is a graphical representation of groups. On the x-axis, you can see the 7 major group attributes, while the y-axis represents the deviation from the average zero of all the groups together. Let's examine each cluster more closely and briefly identify the differences between them. Cluster 1 stands out due to its high number of credit lines. In Cluster 2, all features except for interest rate are below the average line, as you can see on the graph. Cluster 3 consists of loans with the lowest interest rates. Cluster 4, on the other hand, is the opposite of Cluster 2, with large loan amounts and installments, among other characteristics. Finally, Cluster 5 has a significantly higher utilization rate. Okay, now we will combine all the information we obtained from previous analysis and run the Monte Carlo simulation. That is, we are going to get the distribution of all possible outcomes of returns and their probabilities. The following formula will be used to build a model. This part of the equation represents the percentage of returns from good loans, while this part represents percentage of returns from bad loans. When we add these parts together, we obtain the total expected return as a percentage. We can discuss the formula in more detail after the presentation. We divided our budget into equal parts to invest in each cluster so that each cluster is evaluated on the same scale. We're investing a total of 10 million pesos. At this stage, we are investing an equal amount of 2 million pesos in each cluster as mentioned before. After running a simulation, we generated distributions for each cluster separately and for all models combined. There are 2 charts for each cluster. The first one provides an overview of the general distribution, where you can see the average return on investment or the potential loss or income. The second chart shows the probability of obtaining a profit. A quick observation shows that cluster 3 and 5 have only a 20% probability to get any profits at all. Cluster 2 and 4 have less than a 50% chance to get any profit. The combined investment has an average return of -250,000 pesos and a 20% probability to obtain a profit. That is definitely not what we are looking for. Let's see if we can allocate our funds differently to get the best possible return on investment. To determine the best way to distribute our investment among 5 segments for maximum returns, we optimized our simulation model. The optimized model suggests investing all available funds into the first segment, which we defined as active borrowers. We now have an average return of plus 300,000 pesos and 75% of obtaining a profit compared to minus 250,000 pesos and 20% of obtaining a profit from our previous simulation. Let's take a closer look at this segment. This segment makes up 11.7% of all borrowers from Lending Club. This group has above-average income and borrows larger amounts of money at lower interest rates. They have a higher number of open credit lines, indicating more frequent borrowing. They make regular payments, which helps to keep their revolving balance low. We can interpret this information as a group of people who frequently borrows money on favorable terms and pays back on time. The description of the group is here to reinforce our choice of investing money into this group. So we propose active borrowers as an investment target. Based on our analysis, we have concluded that among the available investment options, investing in active borrowers is the best strategy for achieving our investment objectives, with a 75% chance of ending a year with a profit and an average return of around 300,000 pesos, which is 3% profit on initial investments. This marks the end of the presentation given by Nikolajsko Morikov for the Advanced Business Analytics Specialization by the University of Colorado Boulder on the Coursera platform, with the assistance of the AI Reader, on March 3, 2023. Thank you to all of the audience members for staying with me throughout this presentation.